What's going on, guys? Nick Sean here with Mission FX. This is the official Divergence video course with the 4 simple rules for how we trade Divergence here at Mission FX. These rules are valuable, guys. Now, I don't know how much you paid to get into Mission FX. Maybe it was $1,000, $2,000. Let me show you how much these rules were worth to me last year in the year 2017. In the year 2017, I made a little over $62,000 trading across all my accounts. I think it was like 62,400 in profits. This is all profits. And since then, I've grown that money in Bitcoin and Litecoin, and I've expanded that to even more money. So last year, that's how much these rules were worth to me. Just trading these 4 rules. I did nothing but trade these 4 rules last year, for the most part. And so that's how much they're worth. Now, how much were they worth to you? I don't know. Maybe you paid $1,000, $2,000 to get into Mission FX. Whatever it was, these rules are so much more valuable than whatever you actually paid for them. They're going to make you so much more money than whatever amount you invested into them, because this is a lifelong practice that you can do. Me and my 2 administrators have back tested this data all the way to 1999, and the market, as long as these 4 rules are honored, has always worked out with at least a 90 to 95% win rate, as long as you follow these 4 rules to the T and you can properly execute them. So I want you to understand how valuable what I am teaching you in this video is. And I want you to understand that these are the keys to the kingdom. There's a million different strategies out there in Forex, and a lot of them work as long as you execute them properly. This one is no exception. The only thing different about this one is that I found it's had a very, very high win rate. Okay, so I'm going to teach you this right now. I'm going to get right into it. I'm going to keep it as simple as possible, and then everything else we can kind of like go over in later videos that kind of go more in depth. But right now, I'm just going to teach you a very, very simple way to trade this. Okay, now this pattern is called Divergence. What I'm going to do is I'm going to open up the course notes right here on my phone. I just have it saved in the notes section of my phone. I do all my trading from my phone, as many of you guys know, and I do all my teaching from here as well. So that's just simple. So you guys can screenshot this or whatever. So the first thing about divergence is the word divergence as a definition. It just means to move apart. So let's say if you're walking down a road, and then as you're walking down the road, your friend says, "Hey, look, the road is diverging up ahead." Well, what does that mean? That means, well, the road is splitting into 2, 3, 4 paths. The road is it's moving apart. The road is moving in different directions. And so you can either, choose the left side or the right side or whatever. So divergence just means to move apart. So how we look at this in terms of Forex is I'm going to go back to my phone. I'm going to add the indicator I got you guys set up with in the first video, and it's the relative strength index. Okay, so this is how your chart should look when you're looking at this. All divergence means is that whenever the main chart price and the RSI is doing something different, okay? So for example, I want you to look at this set of peaks right here. You see how right here the market goes down and the market pops up, and then it goes lower, and then it comes up for a second right here, then it goes lower, and all these peaks are headed downwards. You see that? I'm going to highlight those same peaks in the RSI window, and we're going to see what's going on here. We can see that as the market is making lower and lower and lower price movements here on the main chart, on the RSI window, it's actually being higher and higher. So every time the market goes lower on the main chart, the market is actually going higher on the RSI window. And we went even lower right here, but this was still higher than these two. So the market was heading upwards here, lower here. All this little pattern this pattern is called divergence. It just indicates that the market can potentially make an upwards reversal. Now, you need to have proper context, you need to have proper trading rules and this and that. So we're going to go over that in this video right here, okay? So let's get right into it. We're going to go back to the course notes. We're going to look at this. So divergence as it relates to Forex trading means that price candles on the main chart will move in one direction, like I just showed you, while price data on the RSI window will move the opposite direction. So the example here that I just showed you is that while the market's moving downwards in the main chart, RSI is showing that these same low peaks are moving upwards, okay? So I'm going to go back here. Now, divergence is a reversal pattern that is used to indicate a potential short-term or long-term trend reversal. If the market has been moving upwards, for example, and we see a divergence pattern form, it is an indication that the market might begin a downwards trend. Now, if you need to pause the video anytime to reread through something or to take notes, please pause the video and do so. If you got to take screenshots, you can take a screenshot, whatever you need to do to learn this stuff, okay? So I'm going to jump right in here to highs and lows, something you need to know. We also call these peaks. Okay, highs and lows and peaks, whatever you want to call them. So let's just look at this very, very simply. When the market goes up and then comes down, it leaves this little point right here, this little area where the market reversed. This is called a peak. The market goes down and then up. It leaves this little lowest point here called a peak. So all of these are peaks. They just go, up and down, kind of like mountain peaks. It goes up and it comes down and it leaves this peak up here. So whenever it leaves a peak like this up here, this is called a high because the market went up here, it made a high, and then it came down. So it leaves this area, we just refer to that as a high. When the market comes down and then pops up, it leaves this little peak in here. We call that a low because the market went down, made a low, and then popped back up. Now this happens all day, like 17,000 times a day. The market will go down, leave a low, and then a high, and then a low, and then a high, and then a low, high, low, high, low, high, low, high, low, high, low. You see, it can be anything, very discretionary. All you do is you just wait to see where the market reversed and you see a high or low, low, high, low, high, low, high. So that is how highs and lows work. Now there's also 4 things that we use to determine them relative to each other. If you look towards the bottom of the screen, we have what's called a higher high, lower low, and higher low. So I'm going to teach you the higher high and the lower high, okay? So let's say that the market is in an uptrend and the market's heading upwards. So I'm just going to find an area where the market was moving upwards. We can look at this right here. Here's the Elliott wave pattern we actually had in the last video that you guys can see here. So the market went up and it made a high right here, right? Then it made a low. Then it went up here and made another high. Now, if we're comparing these 2 highs, right? This is the previous high, compared to this one. So if we're comparing these 2, would you guys say this peak right here, is this higher or lower than this peak? Is this one higher? It's higher, right? So while this is still considered a high up here, we call it a higher high because it is higher than this first high. That's it. It's that simple. So market came up and made a high, went down and made a low, went up and made another high. And if we're comparing these 2, we can say, oh, this one's higher than this one, so it's a higher high. Okay? Now the same thing goes for down here when the market reverses. The market makes a high and then a low and then a high right here, right? But this high right here compared to the previous one right here, this is the previous clearest high. This high is actually lower than that high. So made a high, made a low, popped up to a high, and this is still a high, but compared to this one, this is lower than this one. So we call this a lower high, okay? So the first thing you're going to be doing is you're just going to be determining whether or not the peak is a high or low. And then you're just going to, if it's a high, it's a high. If it's a low, it's a low. And then all you're going to do is you're just going to then look at the previous peak before it to determine if it's a higher high or a lower high. Okay. So this is a high. This is a low. Market popped up again to a high. But wait, what is this? What kind of high is this? This is a lower high compared to that one. So the same thing goes vice versa down here at the very bottom. Lower low and higher low. Let's look at what these are. Okay. So the market, we saw it was in a little downtrend right here. We made a low and then a high, low, high, low, high, low. So the market goes and makes a low right here, right? And that pops up, makes a high. Then it goes down here and makes another low. But this low right here compared to this one, is this lower or higher than this one? It's lower, isn't it, right? And market goes low, high, and then comes down here. This area is lower than this. Now this is still a low, but compared to this low, this one is a lower low. So that's how we get the lower low form. This is a lower low. Low, high, low. This is a lower low. So what about this right here? If we're comparing this low and this low, what is this compared to this? Is this lower or higher? This is lower, isn't it? So this would be considered a lower low compared to this one. Okay. So now there's the same thing right here from this part, which is also the higher low. So I'm going to show you what that is. Pretty simple. The market, made a low here, high, low, high, low, high, low. This is considered a low right here, right? So let's just look at this one. This is a low, and it's just zoomed in. So this is a low, and this is also a low down here. But this low compared to this low, is this higher or lower than this one? This one's higher, right? So we'd call this a higher low. Let's look at it in a little bit more clear of an example, just so nobody gets confused here. So we've got these sets of lows right here, right? High, low, high, low, high, low, the market goes up. So these are all lows, right? So if I look at this low right here and I compare it to this low, what kind of low is this? Is it higher or lower than this one? This one's higher, right? So that would make this a higher low. So that is how lows and highs work. And then that's how all the variations of them, the 4 variations of them work. Higher, high, lower, low, higher, low. You will have to know this before we move on in the next portion of the video. So make sure that you either pause the video and write this down, maybe draw a few examples, maybe look at the charts on your own a little bit, and make sure you understand this before moving along. So pause the video, like I said, at any time, jot this down, and then make sure you know them. So moving right along. Here are the rules to follow when you're trading divergence. Now, there's 2 types of divergence patterns, okay? What we're going to be doing is we're going to be looking at divergence, and we're going to be determining where a divergence occurs. So let me find a good one here on the chart so that I can use for an example, and then we will look at that divergence and then show you how it works. So this right here would be a good divergence pattern. Now remember, I told you that divergence is when divergence, the word, means to move apart. And then in this case, this is where the main chart moves in one direction while the RSI window moves in another direction. So if we're seeing the market make a high right here, right, and it comes down and makes a higher high up here, we'll notice that the market went up right here, made a high, and then it came down, but this RSI, it failed to make a higher high. It failed to get above this one. The main chart had no problem doing it. Main chart spiked up, and this made a higher high right here, but the RSI actually made a lower high because this high is lower than this one. So we can compare these 2 peaks by drawing a trend line that connects them both like this, okay? So I drew that one right there. And then I also drew this right here that you can see. So right here, you can see that the market made a high up here, and it also made a lower high right here. So that's just how we compare the peaks. Now this right here, this is it. That's what divergence is, okay? So you'll understand that this works out very often when you're trading this. If you say, okay, this and this happens, we can predict the next move. A bullish divergence like this is, or I'm sorry, bearish divergence, is when the market makes this divergence pattern and it indicates that the market should reverse for a bit. Okay, so the idea would be you want to sell somewhere in here and then ride the market down as it reverses. All you're going to be seeing as this pattern occurs is this right here. That's all you will see before, you know, the rest hasn't happened yet. So once you see this pattern, you know, okay, the RSI failed to make a higher high. That means the market is losing its strength and the market should turn over for a little bit. Okay, so now we're going to look at the 4 rules so that you guys can understand this a little bit better. So we're going to look at divergence, bullish for buys. Now this type of divergence is a divergence pattern that forms on the chart that indicates that you should buy. Bullish means price is going to spike up. Bullish means like an upwards trend. It means up. And bearish means down. So bullish for buys means we're thinking the market's going to go up. So let's look at a good bullish divergence in the chart, and then we're going to go through the 4 rules so that you know how to trade it. Okay, so let's look at this right here. Okay, let's go to rule 1 of the 4 divergence rules. Rule number 1 is that the initial peak is at or very close to the 25 level. So remember how I just talked to you guys about peaks? Market's going to go down. It's going to make a low right here, right? This is a peak. This is a low peak. This is just a low. You can call it a low or you can call it a peak, whatever you want. Market made a low right here. We're just going to go straight down to our RSI window and make sure it's at or near the 25 level. See this red dotted line? That's the 25 level. So the market either has to come near it, very close to it, or touch it, or go below it. But as long as the first peak is somewhere in this 25 level area, then it is then the first rule is valid. So the first rule, like I said, the initial peak is at or very close to the 25 level. That was it. The first peak came down here. We had an initial low form right here, okay? This is all you're going to be seeing at the time it takes place. You're just going to be seeing that. So that's how it's going to look on your chart as you're watching it live. You're just going to see the low. Now, the second rule, there's a clear upside down U or V movement down towards the sentiment line and then back down. Okay. So we're going to look right here. The sentiment line will just be a moving average in the chart. You can disregard that. All you want to see is an upside down V or U. Okay, so this right here is the market shoots up here and then comes down. So if I were to look at this right here, does this look like an upside down V or U? Yes, the market just shot up and then went down. So it looks kind of like a V, you see? That's just the pattern you just want to look for, just a V, up and down. You don't want to see it go up and then play around and then do this and that and then come down. You just want to see it to just go straight up and straight down, makes a V, upside down V. So that's the second rule, upside down U or V. Rule number 3, the second main chart peak has to make a clear lower low than the first peak. RSI has to make a clear higher low. And you enter only on a fast candle that makes a lower low, not small candles. So let's break down the components of rule number 3. So we're looking at this second peak right here, right? We had rule number 1, the first peak. We had rule number 2, which was the upside down U or V. Now we have this area right here. So let's see what rule number 3 says. The second main chart has to make a clear lower low than the first peak. So let's see. This low right here compared to this one, is this lower? Yeah, of course it's lower. See, it's clearly lower. You can see it clearly went lower. So this is a clear lower low than this first peak, than this first low. So this one's lower, yes. So that first component is there. Second one is, and RSI has to make a clear higher low. Okay, so let's see what RSI did. RSI made our first low right here, right? These two are connected. So that was our initial peak. Came down, made a lower low in the main chart. But RSI, this low compared to this low, this was higher. So this right here is divergence. Now, we can draw the lines connecting these if we want to show a representation of comparing these two peaks. So, whoops. There we go. Sorry, I think I just lost it. Let's go back to where we were at over here on the chart. Alright, here we are. Okay, so now I'm going to pull out the trend line again, and we're just going to connect these. Okay, so you can see on our main chart, price is going downwards, right? But on our RSI, it's representing that price is going upwards. Okay, so these is sloped upwards, this is sloped downwards. The market is diverging from the RSI indicator. See, so this shows divergence. Okay. We're gauging the divergence against the RSI. While the main chart is going downward, the RSI is going upwards. So that's rule number 3. The last component of rule number 3 says that enter only on a fast candle that makes a lower low, not small candles. So fast candle just means the candles are substantially bigger than the ones before it. Now let me ask you this question. See how these candles are really small? They're small, 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 small. But then we see the candles start getting a little bit bigger here, here, and then down here. See this long wick that was made all the way down here? That's a big candle. Now, are these 3 candles bigger than these little small candles up in here? Yes, they are. That's all the third or the last component of rule number 3 says, is that you only take a divergence if you have fast big candles that make a clear lower low than this. If the market just comes to right here and then stops and then starts going up, you don't want to take a trade there. You want to see it go clearly past this low. Do not take a divergence if it only goes right past the first low. You want to see it goes clearly lower on the main chart, and you want to see this peak is clearly higher than that first peak on the RSI window. Okay, so that's rule number 3, is divergence. Rule number 4 is very simple. There's no more than 20 candles between the 2 peaks. Okay, so if we're just looking at these 2 peaks, right? Let's count how many candles are between them. This is our first peak. So we got 1, 2, 3, 4, 5, 6, 7. So like 7 candles. Is that less than 20? The answer is yes. Rule number 4 is satisfied. So we had all 4 rules satisfied right here. All you're going to do is you're going to buy right here as soon as it makes the lower low on a fast candle while it's divergent, while all 4 rules are in place. You're going to enter a buy right here, and then you're just going to hold your trade to, typically we go past the right to the previous peak. Okay, your stop loss, it's discretionary. It depends on the time frame, it depends on the currency pair, it depends on how volatile the market is, and also it depends on, you know, if you're at wave 5 of the Elliott wave. So we're going to go into a few more examples here in the next few videos, and I'll show you a little bit more about that. But the stop loss, here's what you need to know. You want to stop the trade if the market starts slowly consolidating against you. If you're in on the right divergence and you've done your analysis correctly, as soon as you enter, like see right here, the market quickly shot up right back here to this previous peak up here. So it quickly shot up right there. You would have closed the trade right there. And then this would have been, you know, anywhere from, let's see, 6.2 to, I mean, this would have been a lot. So 7.8, So even if you would have entered up here at 6.8 to 7.8, this was like 10 pips on the minute 5. So that's good, 10, 15 pips for this trade right here. That's pretty good. So you would have been out of this very quickly. That's typically how it works out. But if you enter right here and the market just starts going sideways and slowly starts going against your position very slowly, that's when I get out. Sometimes you'll see it'll spike down even further before going up. And for me, I'll just re-enter another trade down here. I'll just stack my entry, and then I'll close all my trades out as soon as the first one is in profit. So sometimes you can stack like 2 or 3 times, or I'm sorry, you can enter one position and then enter another and another, a maximum of 3 open positions per setup, and you can just trade it like that. So, but yeah, stop loss is discretionary. If the market slowly consolidates against you, close the trade. That doesn't typically happen though. You got to follow these 4 rules though. If you follow these 4 rules, you should be winning most of your trades. Like I'm talking 9 out of 10, 95 out of 100. So that being said, that is the bullish divergence. Bearish divergence is almost the same, except it's just flip-flopped. So let's look at a good bearish divergence. Here, I'll find one on the chart. So let's just scroll through. This happens 1,000 times a day, but you want to be taking only the clean setups. Let's look at this one just for example. Okay, so market went up and up and up and up and up and made this peak right here. And as we can see, it's near the 75 right here. So that's the first rule, is the initial peak is at or very close to the 75 level. So 75 level, the market went up and up and up, and the market made this high before pulling back. So it left this high. We're just going to look down here. We can see, okay, that first peak was at the 75 level. Okay, so that's the first rule. Second rule is there's a clear U or V movement down towards the sentiment line and then back up. Again, I don't have the sentiment line on here. Like I said, it's just a moving average. It's just a line. But you just want to see the market go down and then back up in a V or U formation. So if we're looking at this, let me ask you, does this look like a V to you? Like down and then up. First peak went down and then went up to a second peak right here. This right here, the market has made a clear V or U movement. This is a V movement. Very, very clear. Rule number 2 is satisfied. Okay. Rule number 3, the second main chart peak has to make a clear higher high than the first peak. Let's just look at that. So the market made a high right here, right? First initial high near the 75. Came down, made a V or U, and then made a higher high. Is this high very clearly higher than this one? Yes, it clearly went past this first high. So the first component of that is there. So the second main chart peak has to make a clear higher high than the first peak, and RSI is to make a clear lower high. So let's see what RSI was doing. Well, the main chart made a high and then a higher high. RSI made a high, came down, then made a lower high right here. So this high compared to this one is lower. So let's draw it out with our trend lines so that we can just see this. So it's going to be something like that on our main chart. And then right here, we're going to go again to trend line. We're going to connect these ones, okay? Sorry guys, I'm having trouble moving this. Okay, so it's not letting me move it. I don't know why, but okay, anyway, you can see that these ones are going downwards. These peaks are going down, these peaks are going upwards. Now that last component is enter only on a fast candle that makes a higher high, not small candles. So fast candle means a big candle that's comparably bigger to the previous one. So this candle right here, combined with the wick down here, see, with this wick and everything down there, this candle that made the higher high was substantially bigger than these few candles that came before it, okay? Now, not much bigger, but it was still a fast candle. It was not a series of small candles that made the higher high. It was a fast pulse. It was a quick pulse up here. So that rule is in place. The last rule, very simple, no more than 20 candles between the two peaks. Let's just count. So from our initial high, it came right here, right? And then our, sorry, my screen. Then our V movement up to the higher high. So these are our two peaks. Let's do 1, 2, 3, 4, 5. So like 5 peaks. Is that less than 20? Yes. So the answer is yes. All 4 rules are satisfied. You'd have entered a sell right here and then take profit right here at the previous peak. So the market dropped here pretty quickly to this peak. You can hold these trades a little bit longer if you like. This is the minute 5 and it's GBP JPY, which is one of the most volatile currency pairs. I would have held this for maybe 5 to 6 pips, maybe 10 pips. You'll usually be good with 10 pips on the minute 5. And about 5 pips in the minute 1 for most currency pairs. Don't take that verbatim, but typically 5 pips on the minute 1 is a good take profit. 10 pips on the minute 5 is a good take profit. What your job is to make sure you're paying attention in the group chat so that you're seeing us take these trades day in and day out, and you're seeing me enter these trades live as I enter all of them in the group chat. So that way you can tell, okay, yeah, this is a trade I should have taken. This is good. Here's where the take profit and stop losses go. So that way you can understand them a little bit more. There's no black and white way to map out the exact pip take profit for this and that and the time frame. This Forex is a little bit more, complex than that. I've tried to keep this as black and white as possible with these 4 clear trading rules, but there is a component of discretion, a little bit of discretion that you have to use whenever trading this. So take profit, you don't want it to be too far. For the minute 5, about 10 pips is usually good. So if 10 pips was your take profit on this trade, you would have been out 4.8 to 3.8 right here. So about maybe 10, 15 minutes, you would have been out of this trade. With about 10 pips of profit. So that's pretty good. You do that a couple times a day, catch 30, 40, 50 pips a day, call it a week. Even if you finish the week out at like 100 pips, if you can consistently do that with a very high win rate, and losers that only take maybe 2 or 3 trades to make up for, you're going to be very profitable trading this. So yeah, that's it right there. So let's go into a few more things right here. Confirming the trade, you got to make sure it is under the proper market conditions. So for instance, wave 5 of the Elliott wave pattern is where you take these trades. So let's go look at the Elliott wave pattern for the charts that I marked up on. I think I did them, yeah, right here. So let's see, this one was a good one right here. So we saw the market go in a range and it moved out of the Elliott waves, right? You guys have already been through this in that previous video. 1, 2, 3, 4, 5. Up here at 5, you want to wait for a divergence to form, and then you're going to enter a sell on this divergence, okay? So as we can see, these peaks were going upwards, these peaks were going downwards. This was a divergent move. You could have sold right in here. And then you also know we're at wave 5, so there's going to be a reversal anyway. So it may be grounds for you to hold your trade a little bit longer. Like I said, this to this, you could have made maybe like, 40 pips on this or something crazy like that. If you sold up in here and just held it like down into here, down to this previous psychological level, this is like a good, 20 pips. And we're still only on the minute 5, but you're selling and you're holding with the understanding that, hey, this is a divergence. Yeah, but hey, we're also at wave 5 of an entire Elliott wave pattern, like I went through in the previous videos, so you can hold your trades longer. This right here, there's no clear divergences here that we could have traded. 1, 2, 3, 4, 5. If you see a lower time frame divergence like this right here on the minute 1, this might have been like a divergent move, and it technically was down here too. Actually, this was a valid divergent move that follows all the rules. Initial peak near the 25, a pop up, and then a quick pop down on a fast candle down here to this level right here. So these peaks are going up, these peaks are going down. You could have bought right here instantly into profit, and you're at wave 5 of an Elliott wave pattern. So you're at wave 5. The market's supposed to reverse anyways since it's at wave 5. Combine that with a good bullish divergence and you're set to just the market jumping up. So even if you just would have bought somewhere in here from 7.5 and just held to this flat round number, the psychological level, you would have made 15 pips on this trade, even more if you held it longer. So that's just confirming the trade. So for example, if starting on the minute 1, you observe divergence, check the minute 5, obtain some sort of confirmation the market will go in the direction you anticipate. On that minute 5, you can see another divergence. That works perfectly fine. So if you see a divergence on the minute 5 and minute 1 charts, that's like 2 different indications that, hey, the market should reverse for a bit. You should be good to enter a trade. Now another example, if observing divergence on the minute 15, wait to enter until the minute 1 completes an Elliott wave pattern or forms a divergence to enter with the mentality that the minute 15 is set to drop along with the exact moment the minute 1 is set to drop. So that just goes into context here, except we're not on the minute 15 here, we're on the minute 5, but it works the same way. 1, 2, 3, 4, 5. So now we've had like, 1, 2, 3 levels of this drop right here. And then right here on the minute 1, I guarantee you, if you go back into market history, if you go to the minute 1, this will pretty much just be enlarged. And you can see this would have probably been a perfect divergence in the minute 1. So you're combining the minute 5 Elliott wave analysis with a minute 5 tiny divergence. Sorry, that was my dad. With a minute 5 tiny divergence, combined that with a minute 1 divergence as well, because this would have been divergent on the minute 1, you're having three different confirmations that the market should reverse. So that's just taking all that into play and waiting for the perfect setups. Now this right here, you would have seen this is divergent as well, if you look at that. So you could have traded this with the mentality that, hey, the market made wave 1, 2, and now we made wave 3, and now we had a divergence as well. So after wave 3, the market usually pulls back to wave 4. So you could have taken this right here with the mentality, okay, it's divergent right here. We're on wave 3, and we've already made a clear move past the previous wave. Maybe it'll pull back to 4, and you can enter your trade here. Just use a tighter stop loss. So, that's just how you can trade it. So you can trade these Elliott waves both ways. So that's that, finding a confirmation. So example I went through earlier, only enter on a fast candle or set of fast candles. These candles should quickly and clearly break the previous higher low, giving you a perfect entry. The best entries are made on big, fast price candles that are substantially larger than the candles preceding them. Now you can follow this religiously, or you can just follow it for the most part and use it in confluence with your Elliott waves. But just understand, guys, look at this right here. Down, 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 jump up, and then a fast move down. Divergence. It worked out very quickly. Market comes down here, comes down, chops up slowly, fast, quick move down. It's divergent. It worked out very quickly. Understand that you are risking more when you take divergences on small candles. Okay, when you take them on fast candles, they work a lot better. So psychological levels. Why are they important? Psychological levels, like I said, they're just these round numbers every 50 pips. 153.00, 153.5. From here to here was 50 pips, okay? If you go up here to 154.0, that'll be another psychological level. And this works for all currency pairs. Like, let's just see. So on the hour chart, you can see I have more of it marked up. But it's just every 50 pips. All you're going to notice is that the market tends to bounce around at these psychological levels. You see, it just bounces around at them. So if you find a divergence at one of these psychological levels combined with Elliott waves, combined with, a smaller time frame divergence, if you get like 5 confirmations the market should reverse, just understand you have more in your arsenal to counter the market in the direction you think it'll go. So high probability trades can be taken at these psychological levels because the market tends to reverse at them anyway. So if the market is supposed to reverse at these levels anyway for a bit, combine that with the divergence, huge indication you should be able to predict the next move. Timing your entries at psychological levels, wait for a divergent peak to form at a psychological level and enter a trade. Down here, Elliott waves, combining wave 5 and divergence, guys. Divergence works so well at wave 5 that it is very, very... I don't know who this is. That it is very, very predictable to take a divergence if it forms at wave 5. So if you're looking at divergence, scroll to the left a little bit. See if you can count 5 waves from a breakout that you can say, okay, well, we're probably in wave 5 right now. A divergence is also happening. So we can trade that and we can make money off that. So that's how you apply it. The last portion of this video is literally to go make money. So after you watch this video, I want you to go through this video a couple times and the other ones as well. Make sure you take good notes so that whenever we get on a call, if we need a one-on-one session, that you have your notes with you and you also have your questions ready. Write down your questions in your notes so that we can help you out here at Mission FX. But literally the last component is literally go make money. Even if it's in the group chat, even if you're just following the trades we take, yeah, you can take the signals we give out. It's nothing structured, but we'll always call out the trades we're in. I've got everyone in the group always, blowing it up with the trades that they're in. But just make sure, this is my aunt. Gosh, my phone's always blowing up. So yeah, just make sure you're following along in the group chat so that you can take the same trades we're taking and that you're understanding why these trades are working out. I recommend trading this on demo for 2 to 4 weeks, and I recommend that you're profitable for an entire month on a demo account before making the decision to go live with a relatively small account. And then after you've gone live and traded live for a month, then start trading a full-size account like you normally would, and start using position sizes like you normally would, and you can make very easily, like 100, 200, 300 bucks a day just trading this. So that's all you need. This is everything. This is the whole strategy. So you've gone through setting up your charts, you've gone through introduction to Elliott waves, and you've also gone through divergence as the way we trade it here with the 4 rules. And you've also learned how to combine those with other things like Elliott waves, psychological levels, and combining that with different confirmations and different divergences and other time frames. So that is the Divergence official video course, guys. Again, Nick, Sean here. I hope you guys have enjoyed this video. If you need any help, make sure you've watched this video a couple times and taken notes so that we can help you out, so we can answer your questions the best that we can. I encourage you to post your trades in the group. I encourage you to ask questions in the group and go through the analysis there and really stay plugged in. I've had people become profitable with this strategy within 2 to 4 weeks and then fund their account like people are actually making, like, live money, like Christian, Jimmy, my other Christian, my dude Kudo Guab, who quit his job as a firefighter to trade full time. These guys are making hundreds, thousands of bucks a week. So I want you guys to really take this seriously and understand that these 4 rules right here can be the keys to the kingdom for you. All you have to do is follow them. So go through this content, take it very seriously, apply all the concepts I teach, and you should be good. So I will see you guys in the group chat. You guys have a great rest of the day. If you need anything or have any questions, just shoot me a message. I'll talk to you guys soon. Bye.